Hi there, Vince Mohr, your mortgage professional on the Central Coast, Central Valley, and beyond. And today in this video, I'll be talking about the idea of having the lender pay for your closing costs, both reoccurring and non-reoccurring. And if you find this video informative, please consider subscribing to my channel, as I provide lots of good information on home loans, real estate, and the market in general. In the last video, I talked about the seller paying your closing costs, both reoccurring and non-reoccurring, possibly discount points to buy down your rate, and also paying off the entire amount of your mortgage insurance if applicable. The way to entice the seller, if you remember, was rather than beat them up on their price, would be to offer them a full price offer or maybe even a little bit more to get them to pay for your closing costs and possibly a discount point, and as well as pay off your entire mortgage insurance. If again applicable. And if you remember, for every $10,000 borrowed, dependent upon your loan to value, would be an additional few $100 up to maybe as much as $1,000, but you have $10,000 to work with, or 20 or 30, just depending upon how much you ask them to pay for. And again, they can pay up to 6% of your closing cost, 6% of the purchasing price for your closing cost. In this video, the idea is to have your lender pay for your closing costs, both reoccurring and non-reoccurring. The way to accomplish this is by creating what's known as premium or rebate pricing. It's the opposite of paying points to buy your interest rate down. Actually, to create premium pricing, you bump your interest rate up a little bit. And an example would be if 4 3/4 is 0 points, and just closing costs, reoccurring and non-reoccurring closing costs. Then if you bump your rate up to 5%, which on a $400,000 loan, that would increase your payment roughly $60. But if you increase your rate to 5%, then you'd create approximately 1% premium pricing or rebate pricing that you could use towards your closing costs. So if you upped it to say 5 1/4, then you'd create a couple of points, and then you'd probably be able to pay for all your closing costs, reoccurring and non-reoccurring. So it really just boils down to math, how much you increase your interest rate by versus how much you're going to save. Just determines, you just would determine how many months it would take to break even. The average home loan stays on the books anywhere from 3 to 5 years. So paying a little bit higher interest rate with the higher payment divided by your total closing costs. In this example that we're looking at, $60 divided by your closing costs, I think you probably would be okay, and it would make sense for 3 to 5 years. Now, if you end up having the loan longer than that, then of course it may make sense to just go with the par pricing or 0 points, or even again paying some discount points to buy your rate down. But statistically speaking, I think you'll be okay by having a little bit higher of an interest rate with a little bit higher of payments. Once again, thank you for taking the time to watch this video. And again, if you found the information informative, please subscribe, like, and share to my channel. If I could assist you or someone you know with any home loan needs, please let me know. I wish you all the best.